Japan owes more money than any country in history. Not just in absolute terms, as a percentage of GDP, Japan's government debt sits at roughly 264%. That's more than double what the United States owes, more than Greece during its meltdown, more than Italy, Portugal, or any other developed nation you can think of. And yet Japan isn't collapsing, its currency isn't worthless. Investors aren't fleeing. In fact, during moments of global panic, money often flows into Japan, treating it like a safe haven. The yen strengthens, bonds get bought. The world looks at Japan's balance sheet and shrugs. This shouldn't be possible. Every rule of thumb you've ever heard about government debt says Japan should have imploded years ago, decades ago, even. So what's going on? The story starts in the 1980s, when Japan looked unstoppable. The Nikkei stock index was screaming upward. Tokyo real estate was so expensive that, on paper, the Imperial Palace grounds were worth more than all of California. Japanese companies were buying Rockefeller Center, Columbia Pictures, golf courses in Hawaii. American politicians were writing books with titles like The Japan That Can Say No. The fear wasn't that Japan would fail. The fear was that Japan would win. Then the bubble popped. In 1989, the Bank of Japan raised interest rates. To cool things down, it worked a little too well. Stock prices collapsed, real estate cratered, banks that had lent trillions against inflated assets suddenly had balance sheets full of holes. The government stepped in with stimulus packages, public works projects, bailouts. They spent and spent, trying to restart growth. It didn't work, not the way they hoped. Growth stayed anemic, deflation set in. Prices stopped rising, which sounds nice until you realize it means consumers delay purchases, businesses delay investment, and the whole economy gets stuck in a slow-motion spiral. Japan entered what economists now call the lost decades, plural. So the government kept borrowing, they built bridges to nowhere, paved roads in villages that were already shrinking, kept zombie companies alive, and the debt piled up. Here's where it gets strange. Normally, when a government borrows this much, bond markets get nervous. Investors demand higher interest rates to compensate for the risk. Those higher rates make the debt even more expensive, which makes investors even more nervous, and you get a doom loop. Ask Argentina, ask Greece. But Japan's interest rates didn't spike, they fell. By the late 1990s, Japan's 10-year government bonds were yielding around 1%, then 0.5%. By 2016, they went negative. Investors were paying the Japanese government for the privilege of lending it money. Why? Because of who was buying the debt. Most of Japan's government bonds aren't held by foreign hedge funds or Chinese central banks. They're held by Japanese institutions, banks, insurance companies, pension funds, and increasingly the Bank of Japan itself. As of recent years, the BOJ owns nearly half of all outstanding government bonds. They've been buying them by the truckload since 2013 as part of a policy called quantitative easing. The central bank prints money, buys bonds, and pushes rates down to keep borrowing cheap. This is the magic trick. Japan borrows from itself. The debt is denominated in yen, which Japan controls. The creditors are mostly domestic, so there's no flight risk. And the central bank can always step in to buy whatever the market won't. It's a closed loop, but closed loops have consequences. For one, this only works because Japanese savers keep saving. Japan has one of the highest savings rates in the developed world. Households sit on mountains of cash and deposits. That money flows into banks, which buy government bonds, which fund the deficit. It's a cycle that depends on cultural habits and demographics. Japanese people save because they don't trust the pension system to be enough. They save because wages have been flat for 30 years. They save because there is not much else to do with the money in a country where real estate crashed and never recovered and the stock market took decades just to get back to 1989 levels. But Japan is also aging faster than almost any society on Earth by 2040. More than a third of the population will be over 65. Retirees don't save, they spend down. As the workforce shrinks and the elderly population grows, the domestic savings pool that funds the debt could start to dry up. If that happens, Japan would need to borrow from abroad, and foreign investors might not be so forgiving. There's another problem. All this debt has to be serviced. Even at low interest rates, Japan now spends roughly a quarter of its annual budget just paying interest. That's money that can't go to schools, infrastructure, or dealing with an aging society that needs more healthcare and elder care every year. If rates ever rise, even modestly, the math gets ugly fast. So why hasn't Japan just inflated the debt away? That's the textbook move. Print money, create inflation, and watch the real value of the debt shrink. But Japan can't seem to generate inflation, no matter how hard it tries. They've tried negative rates, quantitative easing, yield curve control. The BOJ has bought stocks, bonds, real estate trusts. For years, they set an inflation target of 2% and missed it over and over. Deflation is embedded in the psychology. Businesses won't raise prices. Workers won't demand raises. Everyone expects stagnation, so stagnation persists until recently, in 2022 and 2023. Inflation finally ticked up, partly due to global energy shocks and supply chain chaos. Suddenly, Japan had inflation again, and it created a new problem. The BOJ had spent years capping bond yields to keep borrowing costs low. But if inflation rises and yields stay artificially suppressed, real returns go negative and investors start looking elsewhere. The yen weakened dramatically, the BOJ had to intervene in currency markets. They were trapped between letting yields rise, which would explode the debt cost, or keeping yields low, which would trash the currency. In early 2024, they finally started letting rates inch upward. The era of extreme easing might be ending, but the debt is still there, all 264% of it. Here's the uncomfortable truth: Japan's system works until it doesn't. It functions because of a unique set of conditions: a captive domestic investor base, a compliant central bank, a currency the country controls, and a population that saves obsessively. Remove any one of those, and the math changes. Other countries look at Japan and wonder if they can do the same thing: borrow forever, print money, keep rates at zero. Some economists argue modern monetary theory makes this possible for any country that controls its own currency. Japan is the test case, but Japan is also a warning. 30 years of stagnation, wages that haven't grown since the 1990s. A generation that has never known booms, only the grind, youth unemployment that stays low only because young people have stopped expecting much. A society that works harder than almost anywhere on earth and still feels like it's falling behind. The debt didn't destroy Japan, but it didn't save it either. It just bought time. Time that was spent building roads nobody needed and propping up companies that should have failed. Time that could have been used to restructure the economy, embrace immigration, invest in innovation. Instead, Japan chose the comfort of the status quo. And now the bill is coming due, not in a sudden crisis. Japan doesn't do sudden, but in the slow arithmetic of aging demographics, rising costs, and the shrinking room to maneuver. The question isn't whether Japan can keep borrowing, it's whether all that borrowing ever actually solves anything, or whether it just delays the reckoning until the next generation has to deal with it. Japan got rich with endless debt, but it stayed stuck there too.